Everybody, Dave here, Hidden Freedom, and welcome back to another Saturday video. In today's video, we're going to go over the ETF Kng, which I talked about in last week's video, the ETF Food Pyramid video, which by the way was one of the most successful videos in the history of this channel. So I appreciate everybody that watched that video, that shared it out. There was a lot of shares on that video, and I highly appreciate that. So if you're returning back to the channel, welcome. If you're new here, consider subscribing to the channel for content such as what we're going to talk about today. In today's video, we're going to talk about Kng, and I talked, I kind of didn't really go in detail about it in last week's video, but it kind of fits in the growth income dividends section right here, and here it is right here. Now Devo is another ETF that's similar to Kng, or Kng could be considered similar to Devo. They have a relatively similar strategy, but I'm not going to compare the two ETFs in this video. We will do that in a future video. So we just want to talk about Kng in this video, so let's go ahead and get started. The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. So the first thing we need to talk about is what a dividend aristocrat is. Now, I have talked about in the past how to build a dividend portfolio basically from scratch. And in that video, I kind of talked about dividend aristocrats and I kind of talked about dividend kings. So if you're interested in building a dividend portfolio with individual stocks from scratch, take a look at that video. So I pretty much go through all the basics on how to build a dividend portfolio from scratch. All right, to be considered a dividend aristocrat, you got to meet these criteria right here, be in the S&P 500, have a consecutive 25 years of dividend increases, and meet a certain minimum size and liquidity requirements. In general, most stocks in the S&P 500 meet the minimum size and liquidity requirements, but in some cases it could weed a few out as well. So right now, as of January 3rd, 2022, there's roughly about 66 dividend aristocrats. So let's talk about a dividend aristocrat real quick here. We'll look at my dividend portfolio here. So let's go to current portfolio and look at all my individual positions. So here is all of the individual positions right here. Now I have a hybrid portfolio. It's individual positions plus ETFs, income ETFs and stuff down here. But if we scroll all the way over to the right over here, we will see a field here called is aristocrat or king. Now, what this is based off is the consecutive years of dividend increases, right? If it's 50 years or more, it's a king. If it's 25 years or more, it's an aristocrat. So you can see in my portfolio of individual positions, I have quite a few dividend aristocrats and I have quite a few of, dividend kings there. Now, just to give you an example here, we got McDonald's, that's an aristocrat there. We have Pepsi, that's an aristocrat. We have Kimberly-Clark, that's an aristocrat. Caterpillar, Realty Income, we got APD there, and we got Chevron and ExxonMobil. So that just gives you an example there of some dividend aristocrats, right? These are solid companies. So looking here at basically this is the fact sheet for Kng, and I don't understand why they call this ETF Kng, because it's not kings at all. And you'd think they would name it something that's kind of a derivative of aristocrat, but I guess it is what it is, right? Kng should be really for dividend kings. Maybe I would have to look up to some research. Maybe there actually is an ETF that's similar to this one that's based on kings only. Although there wouldn't be very many stocks in that particular ETF, obviously. But so let's talk about this because this is a pretty darn good ETF here. I'm going to give you the pros and cons at the end of the video, why I like it and why I don't like it. But that doesn't mean that it shouldn't be in your portfolio. Maybe this is a good replacement for your individual stocks. This exchange-traded fund seeks investment results that correspond generally to the price in index before funds, fees, and expenses of an equity index called CBO S&P 500 Dividend Aristocrats Target Income Index Monthly Series. Now say that 10 times fast. All right. So scrolling down here, we can see the fund's inception date as March 2018. Expense ratio is 0.75. And I think the yield is roughly about 3.3% on this ETF at this time. The index is a rules-based buy-right index designed with the primary goal of generating an annualized level of income from stock dividends and options premium that is approximately 3% over the annual dividend yield of the S&P 500 index, and a secondary goal of generating capital appreciation based on the price returns of an equity securities contained in the index. The index is comprised of two parts: an equal weighted portfolio of stocks containing the S&P 500 Dividend Aristocrat Index, the Aristocrat stocks that have options that trade on a national securities exchange, a rolling series of short written call options on each of the Aristocrat stocks, the covered calls. The covered calls are written, so sold to open by the index on the third Friday of each month, with an expiration typically on the third Friday of the following month, and a strike price as close as possible to the closing price of the underlying stock price at time of covered call is written. So they're doing a 30-day DTE, which is days to expiration. The index employs a partial covered call strategy, meaning that covered calls will be written on a notional value of no more than 20% of the value of the underlying Aristocrat stock. The equity portion of the index is rebalanced quarterly and reconstituted annually. So now that we know the nuts and bolts of this ETF here, we know that it's filled with about 66 stocks of S&P 500 Dividend Aristocrats, which means it has to meet a certain criteria to even be in there and to be in this list. And then we also know that they're running about 20% of the covered calls against any position. So if we pick a company from their holdings, so let's just say XYZ company, which is not a real company, by the way, and if they have 20,000 shares in that company, they're only going to have the cover calls for roughly about 40 contracts, which if you times each contract by 100, because every contract is 100 shares, that comes up to 4,000 shares. You times that by basically 5, which is 20%, and you get roughly about 20,000 shares. So what this essentially allows this ETF to do is it allows the ETF to capture still upside in the market, but still generate income by covered calls. And I know some people are just not familiar with options. They're not familiar with covered calls. They're not familiar with just writing options in general and how lucrative it can be to generate income. So they might not think that this ETF is stable. They might not think that this ETF is, they think it could go to zero, or they think it could be risky and all that. And a lot of that comes down to just knowledge. It comes down to people not understanding what options really are and how they can be used to generate income in a very safe way. In this case here, they're only using 20% of every stock here to generate income off of, and the rest of it is free. So that's 80% is free that they can capitalize on the upside of the market. So here are the holdings of the Kng ETF here. Now, obviously, this is all of the Dividend Aristocrats that are out at this time. It shows 126 positions up there, but you got to understand, you got to basically divide that by 2, because every one of the positions have a cover call on. So it's really half that, right? So right now there's roughly about 66 Dividend Aristocrats. So probably when they put this portfolio together, there was a couple less on the actual list. So I know, for example, AT&T just recently fell off the Dividend Aristocrats list, but guess what? It's in this portfolio. There it is right there. So they haven't reconstituted this portfolio yet. And the next time that these call options expire, which is February 18th, or it could be March, we'll see when they actually reconstitute it. They're going to take AT&T out of this list, and they're going to add 2 new ones to the list, which I think that Sure Dividend has on the list here. Let's see here. So there's deletion right there. AT&T fell off the list, and we got Brown & Brown, which I think is an insurance company, if I'm not mistaken. And then we got Church & Dwight there. So those got added to the Dividend Aristocrats list, and then AT&T came off, so FU AT&T. Scrolling all the way down at the bottom, we can see all of the cover calls down here on all the positions, and they all expire on February 18th. So there you go. They're pretty transparent. Every one of the positions have cover calls on, and you can see all the contracts right there. So negative just means that they sold to open, and then the number is the number of contracts there. and then you times that by 100 to get roughly how many shares it's equal to. So in this case here, Chevron, for example, down at the bottom, 27 contracts, which is 2,700 shares. And that's roughly about the value of the position, so $25,000. Another thing to note about KNG is the kind of the sector makeup of the 64, 66 stocks that they have in their ETF. And now consumer staples is quite heavy. And that makes sense. Why? Why does that make sense, Dave? Because there's a lot of stocks that are in the Dividend Aristocrat that fall in the consumer staples list, right? Procter & Gamble, for example, Colgate-Palmolive, for example. You also have like KMB, right? Kimberly-Clark. There's a lot of stocks that are solid companies that fall in that staples list. And unfortunately, you're always going to be overweight in staples, just like I am in my dividend portfolio as well, because there's a lot of stocks in there that are just quality dividend aristocrats that you need to have in your dividend portfolio. And we can see that communication services is all the way back down to 1.5%. And I bet you that's even going to go down lower once AT&T gets booted from this ETF. Information technology is low because guess what? There's really only two dividend aristocrats in that particular sector, and that's IBM and ADP, automatic data processing, which I don't even really consider that a technology company, but it is. So they do have all 11 sectors in this ETF, and they have real estate in there, which is kind of a plus because not a lot of ETFs have that in there because they're not qualified dividends. In this case here, Realty Income is a dividend aristocrat, and Federal Realty Trust is a dividend aristocrat as well. As a matter of fact, I actually think it's a king. So before I move on to the charts on KNG, I want to talk about the tax information here. The fund's distributions are taxable and will generally be taxed as ordinary income or capital gains. Distributions on shares held in a tax-deferred account, while not immediately taxable, will be subject to tax when the shares are no longer held in the tax-deferred account, which basically means when you get to be 59 and a half and you start distributing, depending on the type of actual account it is, like a 401k, for example, or an IRA, you'll be taxed when you take out those funds, whatever bracket you fall in. All right, so a lot of the income ETFs that I've been doing on my channel, a lot of them say this right here, and a lot of them just say it's NII or it's ordinary income, or it could be a mix of capital gains or something like that. A lot of them do return on capital, and they don't state that. Some of them don't state it in their tax information here, so just take that for what it is. This could do return on capital. I'm pretty sure it probably doesn't. I'd actually have to look and dig deeper to find out if they actually release any of the tax documents. But so this would actually be a great ETF for a tax deferred account, in my opinion. So we're looking here at FinViz, and this is one of my favorite websites, by the way. So KNG, we're looking at KNG, and this is basically going back all the way to April, May of last year. And this is what the chart looks like. It kind of looks ugly, don't get me wrong. It just, it is what it is, right? But in general, this ETF has performed pretty well. So year to date, it's down only 6%. And guess what? You're thinking, oh, it's down 6%, Dave. Well, guess what? The S&P 500 is down 9% right now. So KNG compared to S&P 500, and the KNG has held up better than the S&P 500 has. And this pays a 3.37% dividend at this time, which they stated in their document that it wants to basically have roughly 3 times what the S&P 500 is. Here's a comparison of KNG since inception against the S&P 500 here, because I know people want to know how well this performs, and we'll talk about that at the very end of the video when I give you my pros and cons. But so right here, we're just looking at the growth of $10,000 based on dividends being reinvested. KNG returned a total of 56% versus the S&P 500 returned 77%. So your $10,000 grew to $15,600 for a KNG, and for a SPY returned roughly about $17,765. So you're thinking, Dave, why do I want to be in this ETF? I could just be in SCHD, VIG, DGRO, VYM, for example. Or I can be in VTI, VU, and just outperform KNG in the long term, yes. KNG could play a role in your portfolio. If you're looking for a little bit higher yield, but you want more stability and you want more, defensive play, but you want a little bit higher yield, right? So it pays roughly about 3 and some change. which is roughly about 3 times more than VTI or VU. So you're going to have a little bit more yield out of KNG. It's going to hold up on the bottom side. So right now, KNG is only down 6%, roughly, a little bit more than that. And then SB 500 is down roughly about 9%. So there you go. That's a good example of the reason why KNG could play a role in your portfolio. If you want something that pays out a relatively decent yield, it's super solid, super stable because it's built up with stocks that have a track record of paying their dividends every single year consecutively for 25 years. Not to mention a lot of them should have a dividend growth rate as well. So in my opinion, KNG could play a role in your portfolio, especially if you're looking for something that holds up well in a declining market. So that brings us to the cons for KNG. In my opinion, the con for KNG for what it is, now take this, with a grain of salt or without a grain of salt, is it has a relatively high expense ratio for what it is, in my opinion, especially compared to Devo. Okay, so we'll talk about Devo and KNG in a comparison video in a future video in a few weeks or so. So KNG has a 0.75 expense ratio, which in general is okay given what they're doing, but it's not a monthly payer either. It's a quarterly payer. So with Devo, it's a monthly payer. And so what I would say is either the expense ratio should be slightly lower or they should be paying monthly, because that expense ratio, in my opinion, kind of dictates that it should be paying monthly. I also think that KNG, now this could be debatable, that KNG should pay a little bit higher yield than it's actually paying, but I guess that's kind of debatable. I think it should be paying upwards about 4% or so. So KNG, you need to figure out whether or not that plays a role in your dividend portfolio. And it's probably going to be a little bit more stable than SCHD. It's going to have a little bit higher yield than SCHD. But is that something that you want? I don't know. You need to figure out that for your situation, for your time horizon, for your risk tolerance and all that stuff. And I highly recommend you take a look at last week's ETF food pyramid video. And I kind of talk about every one of these ETFs in general, and every one of these sections in this particular chart as well. So let me know what you think of KNG down in the comments section. Would love to hear your thoughts on it. Could it play a role in your dividend portfolio? So if you have any comments, questions, concerns, leave a comment down below. Until next time, we'll see you in the next video. Thanks for watching.